As we continue our conversation about Chapter 5 and itemized deductions, we'll move into a broad area of charity and deductible gifts to charities. And there's been a significant change in the tax code as a result of the 2017 Tax Cut and Jobs Act. And we'll talk a little bit about those as we discuss these gifts to charities. So generally, a charitable contribution can be claimed as an itemized deduction on Schedule A. But the amount of this deduction depends on certain AGI limitations or adjusted gross income limitations. And generally, in order to be deductible, the donation must be either cash or the value of property. And in some cases, that value will be fair market value. Other times, it'll be based on adjusted basis. So, of course, depending upon the nature of the charitable contributions, for example, cash to qualified charities, are deductible to the extent of 60% of AGI. There is a 30% less frequently or less often used deduction that applies to contributions of appreciated capital gain property. And then finally, a much even less often used limitation of 20% applies for those donations of capital gain property that are made to private foundations. I mentioned earlier the valuation of these properties to charities are generally based on their fair market value. I also said there was an exception to the general rule, and that is that if they donate a property to a charity and they don't use it for its intended purpose, that is, an unrelated use, then the contribution must be reduced by the amount of that long-term capital gain that would have been realized had the contributor or the donator just sold the property. Just to go back for a minute to deductions for charitable contributions, in the assignment that's due for next week, I'll be going through at the end of this video some of the exercises that relate to calculating deductible gifts to charities. I also recommend that you read all of the rest of the PowerPoints in the chapters to round out the conversation that relates to this deduction as well as to the others. Significant changes in the area of itemized deductions that relate to casualty and theft losses. Under this new law, a personal casualty is deductible only if such loss is attributable to a federally declared disaster by the President. That was not the case before this Act of 2017 was put into law, or became the law of the land. This significantly reduces the deductibility of a great deal of casualty and theft losses. So we know a casualty, it qualifies when it is identified as something that is sudden, unexpected, or unusual. And so, for example, if a home had termites over the course of several years and it caused damage, that damage is progressive and gradual, and therefore it would not qualify as a casualty. Also, to the extent that a qualified casualty is reimbursed, for example, by an insurance company, that reduces the amount of casualty loss that is deductible. So you would take the amount of the casualty loss that qualifies for deduction, and you would reduce it by the amount of the insurance recovery. We know, for example, to determine the loss in value, we would take the fair market value immediately before the casualty and compare it to the reduced fair market value after the casualty. In terms of the adjusted basis, because I mentioned earlier some properties we need to know what the adjusted basis is to determine the loss. Generally, we would have to determine the loss from the sale or of other disposition of the property involved. To determine a taxpayer reports a casualty on the tax return, And again, any losses that relate to the casualty could be theft, losses by theft. Generally, though, that any losses, even by theft, have to be in relation to a declared disaster area. And then, of course, as we said, we net that against any recovery through, for example, insurance claims. An example of a theft loss related to a casualty might be if, for example, a tornado went through and somebody had some valuable coins before the tornado. They came back. The tornado was a federally declared disaster area. And they noticed when they came back that the coin collection, someone had come in and stolen some of their coins. Well, this theft loss qualifies as a casualty that could be deductible because the theft occurred in relation to a disaster that was a federally declared disaster area. So to calculate the amount of the casualty, first we deduct $100 for each separate casualty. Now this isn't per item, this is per casualty. So if someone suffered a flood at one time of the year and a tornado at the other time of the year in the same year, then we would take $100 off each casualty separately. But if they lost several items of property within each casualty, then it's just $100 for the entire casualty that needs to be netted out. Once you take out the $100 per casualty, then the amount that is deductible for casualty and theft losses is subject to the amount in excess of 10% of adjusted gross income. So if we have casualty and theft losses that are less than 10% of AGI after taking out the $100, there would be no deduction permitted for deducted casualty and theft losses. And we'd use Form 4684 to calculate the amount of the net loss. As a result of the Tax Cut and Jobs Act of 2017, the miscellaneous itemized deductions have been eliminated. So there used to be a miscellaneous itemized deductions for things like union dues and subscriptions and lockbox fees. And those kinds of things, if they exceeded 2% of AGI, they were deductible to that extent. Those deductions, those miscellaneous itemized deductions, have been eliminated. And in its place, they now have what's called other itemized deductions. And by the way, this other itemized deductions category is not subject to an AGI limitation, but it's very narrowly defined. For example, gambling losses. Gambling losses can only be deducted to the extent of gambling winnings. So someone cannot report on Schedule 1 of 1040 a net gambling loss. They can, however, like I said, offset any gambling winnings against gambling losses. And that would be calculated on Schedule 1, as I said. And then casualty and theft losses of income-producing property, we'll talk more about this in future chapters, also may qualify as other itemized deductions. I wanted to go over just briefly a few of the, at least one of the chapter assignments, maybe a couple of them, that we have in your assignment for Chapter 5. One of them relates to medical expense deductions, and here, using some altered data, we have raw incurred and paid the following expenses, prescription drugs, vitamins over the counter, doctors and dentist visits, health club fees, hair transplant. So we want to know what are the medical expenses that are deductible. Turns out the only medical expenses that are deductible would be the prescription drugs, because they're prescribed by a doctor, and the doctors and dentist visits. Those are the only two that we could deduct for medical expenses, again, assuming they exceed 7.5% of adjusted gross income. All the rest would not qualify. Vitamins and over-the-counter cold remedies are not prescribed. A health club is health maintenance, and that would not qualify, nor would hair transplant surgery qualify as medical expenses. This next question in Connect relates to contributed property, and I mentioned earlier that the property that's contributed is generally valued at fair market value, but there are some exceptions to that, and that is that if the charitable organization does not use the contributed property for its intended purpose. So let's look at this example. Assume that Adrian's AGI is 80,000 and her base is in the vase is 16. How much can she deduct? Well, in the first instance, the value of the vase is 37,000. AGI is 80,000. As we said, the basis of the vase is 16. So the amount in Part A that the taxpayer can deduct is going to be the minimum of, and I'm just going to slide this over, it'll be the minimum of 30% of the AGI, which is 80,000, so 30% of 80,000 is 24,000, or the value of the base at the time of the donation, which is $37,000. So in this case, the taxpayer is limited then to $24,000, which is 30% of the 80,000 AGI. In the second case, the answer would change if instead of displaying the vase, the museum sold the vase to an antique dealer. Well, now the vase is not being used for its intended purpose, and the parameters change a little bit, and so now the vase is going to be the minimum of the 60% of the 80,000, which is 48,000, or $16,000, which is the basis of the vase. So it'll be the lesser of those two. And in this case, the basis of the vase, that is to say in the hands of the contributor, was 16,000, and the 60% of the AGI is 48,000. That's much more. So we'll take the lesser of those two, and it's 16,000, which, as we said, is the basis of the vase. Just wanted to go over those two examples of problems you'll see in Connect for this week. If you have any questions on these or any other problems or concepts in Chapter 5, please let me know.